We'd like to welcome everybody to our FHA versus USDA Home Loan Realtor Jam. Today we're going to be unraveling some of the differences between the two products, what's different about them, and why it's important for you guys as realtors. So I'll just take some time for introductions. Next slide.
Oh, hang on. Messed it up.
There we go. We've got a couple of lenders that'll be on today with us, and myself, Larry Johnson and Heidi Thompson, the two mortgage area managers. We also have Robert Bauapay and Drew McKinney, our two lenders in Rochester and metro areas. We also have Aaron Mathowitz and Shelby Borg. Shelby's in charge of Montevideo, Dawson, Ortonville, Florence, Wilmot. You get the idea. Big Stone, Summit, a lot of the areas over in the west part of the state. And we also have, should be Brianna next here, Brianna Erdman from our Redwood Falls area. She's located where our corporate headquarters are, also in charge of Gibbon, Danube, and Bellevue. And then Melissa Olson in charge of Mankato, Rochester, and Waseca areas. And then Sandy Mullenkamp, our new lender up in St. Cloud here. So without further ado, I'm going to go ahead and let Melissa take over the reins, and we'll get into some of the differences between the products.
So first things first, Larry, we need to change Brianna's name since she's now married and it's not that name anymore. So we need to change that. So make a note of that. Okay. So actually, I'm super glad that Brittany is on with us because she's the whole reason why I wanted to do this presentation, because there was two different, we were going back and forth between two different kinds of loans and which one is, how are they different and which one is more difficult. And so we'll go through the differences. What is an FHA loan? A Federal Housing Administration loan is a mortgage that is insured by the FHA and issued by a bank or other approved lender. Some advantages include easier credit qualifications, low down payment, affordable mortgage insurance, lenient debt to income, and non-occupant co-borrowers. A typical borrower does not have great credit or a large payment. USDA, what is a USDA loan? It's United States Department of Agriculture loan and is ideal for borrowers with lower incomes who want to buy in rural areas. There's no down payment and no cash reserves are required. Closing costs can be rolled into the loan, but there are geographic restrictions. This typical borrower does not have great income and can't access a traditional loan. A lot of messing back and forth because of my computers. Eligibility requirements for USDA, minimum credit score of 640 or above. Lower scores can qualify, but they're going to need additional evaluation. When this happens, it's called a manual underwrite and can take additional time. Housing DTI is 29% and overall DTI is 41%. So this is one loan where we always look at the two ratios as opposed to just the end DTI. They must meet income limits for designated county and metro areas. Must be
Melissa,
yes.
I think you're on FHA. I'm sorry.
Oh, sorry.
Yeah, just wanted to.
Thank you.
Yeah, just wanted to.
Let's go backwards. I guess I could have.
Whatever screen you want to put up, it's just right now it's FHA.
Well, let me go back to. Well, let's just start over then from the FHA. FHA is a Federal Housing Administration loan. It's a mortgage that's insured by FHA and issued by a bank or other approved lender. Some advantages to the FHA loan are easier credit qualifications, low down payment, affordable MI, lenient DTI, and non-occupant borrowers. So I already read this, right? Typical borrower does not have great credit or larger down payment. So then USDA, let me just read it to you twice. All of it. USDA loans, we kind of already read this over. They must be unable to meet qualifications for any other type of mortgage. They must be a U.S. citizen. And you can fund 100% of the purchase price with the USDA loan. Did we read all this, Larry? No, I'm lost.
We went
No.
over eligibility requirements, I think, for USDA, but I don't, you had the FHA slide up.
Okay, so I'll just reread this again.
Let's start with this one.
Yep, eligibility requirements for FHA, minimum credit score of 500 would require 10% down payment. 580 or above would be 3.5% down payment, and 600 or above is most commonly needed. With all of these loans, one of the things that you need to keep in mind is that most lending institutions will have overlays that mitigate risk and will change some of the requirements. So in some of the slides, we'll have what Minnwest specifically would require to do one of these two loans. There's no income limits to qualify for FHA. High DTI or low credit may trigger cash reserve requirements. Mortgage insurance required and is for the life of the loan. U.S. citizenship is not required to obtain an FHA loan, but an immigrant must have lawful permanent residence status. Kind of went over that already. So quick facts on USDA versus FHA. USDA has 0 down payment. You can get up to 6% seller pays for closing costs. FHA is 3.5% down payment, up to 6% from seller for closing costs. USDA has a 0.35 mortgage insurance calculation and a 1% upfront fee financed into the loan. FHA is a 0.85 mortgage insurance calculation, 1.75% upfront fee financed into the loan. This is kind of one where Minnwest differs. One of our overlays is we require a 640 or above credit score for a USDA loan. And for an FHA, we like to see 600 or above. USDA must be in an eligible area, county income limits, and there are no loan limits. An FHA, you can purchase anywhere in the United States. There is no income limits, but there is county loan limits. One of the other things are one of our, I don't know if you call it an overlay, but each lending institution might not be able to lend in certain states. So even though an FHA loan could qualify for a state, we may not be able to do that loans. For instance, we can't do loans in Texas. So that would be one of the things. FHA appraisals. There is a little bit of a difference between an FHA and a USDA appraisal. The main difference of an FHA appraisal is the focus. You need a specialized appraisal known as an FHA appraisal, and not all appraisers are qualified. Appraisals place a special emphasis on the safety and soundness of the property. Common items reviewed are heating, plumbing, electric, roofing, windows, paint, and staircases. And on USDA appraisals, they must conform to USDA quality assurance guidelines. Common items reviewed are foundation, attic and crawl spaces, roof, plumbing, heating, electrical, paint, windows, septic, if applicable, and staircases. Any defects or repairs need to be made before the loan is closed. That's just some of the differences between FHA and USDA, although they seem to be a little bit more, I don't want to say of a problem, but a little more detail involved. They do make borrowing to a wider array of people possible. So I think that's it. We just open it up to questions. If anybody's got any.
Yeah, so I will add a little bit to this here, and some of the other lenders, if you're on and you want to speak up there, some of the more common things that I think we run into as lenders, and even Rebecca, one of our underwriters is on right here, can state that we need to, the peeling paint is a real big issue with these government loans. It's one of the overlays that they're really concerned about, is gets to the safety and soundness. So paint, windows, and foundation are the three issues you really want to take a look at. So if you have a property that you think might have issues in one of those areas, probably not going to be a good fit for one of these loans unless the homeowner can get it fixed before the closing or has some sort of a plan to get it taken care of. I'm trying to think if there's any other big deals. I know handrails were an issue. Smoke detectors can be. GFIs in the bathroom or the kitchen, which is a ground fault electric switch. Anything else you guys can think of or that you've run into on some of your loans?
Open wiring, like in the basement, like for people that have unfinished basements, if you have wires that don't have plugs on them, that's usually a pretty big no-no.
Shelby was mentioning when we were running through the slideshow that decks and making sure, so we kind of tried to bundle all that into staircases, but decks have to have railings, the appropriate railings, things like that.
Yeah, just basically making sure that the entrance to the house, however you get to the house, is within that safety and soundness. So, you know, on construction notes too, or just purchases on these, when you are walking up steps, a lot of times I've seen they need to have railings at least on one side in my area. So that's what I've seen a lot of out here.
Mm-hmm.
The other thing is a lot of times with these loans, we're possibly doing them in conjunction with a grant of some sort. We're trying to get this home buyer funds to help with their closing. So it's usually a good idea on these USDA or FHA loans to ask for about 45 days or less. Closings can be done in 30 days, but there's a lot of extra work that goes into the back end of them. So it is nice to have just a few extra days in case something goes a little bit sideways on them. Gives us time to kind of basically mitigate anything that might happen. So, but they're very good products. Let's be honest that a lot of our first-time home buyers, they don't all qualify for conventional loans. This is a great plan B, either one of these. And USDA I prefer because I think from my personal experience, I've had really good luck with them. But again, they have to be in a rural area. If you're close to a metro location, chances are, you know, we just got to look at the map and make sure that it fits the bill. But very useful products for our clients, and it's a great way to get their foot in the door on a property.
Yeah.
All right. Any questions from anyone? Or any other add-ons, takeaways? All right. If not, we could wrap this one up early and let you all get back on your day here. But that's really the long and skinny of it. Two very useful products. And just remember, the appraisal is the thing that's really the main difference on here. Most of the time with a conventional loan, bank is looking for an appraisal to make sure that the value is there. And while we're looking for the value on FHA and USDA, they are looking at some other things to make sure that it meets those government standards of safety and soundness. So it's just something that's a good idea to have a chat with your lender about those and let them know if you think the property may or may not meet some of those conditions or might be challenging. We can kind of review them together, lenders and realtors, to make sure that we're basically giving the best foot forward for our clients. So with that being said, we want to thank you all for attending today's Realtor Jam. We will send out a copy of the recording to everyone that wasn't able to make it, and we'll invite you all to the next one next month. All right, thanks everybody.